If you have ever read that a Singapore grant covers up to some percentage of your project and assume that means a percentage of everything you spend, this video is going to save you from a common and expensive surprise. Grants almost never co-fund your whole bill. They co-fund a slice of what the scheme calls qualifying costs, and everything outside that definition you pay for yourself. Understanding which of your costs actually qualify is the difference between a claim that goes smoothly and one that comes back far smaller than you expected. In the next few minutes, we will walk through what a qualifying cost really means, what tends to count, what usually does not, and how to document it so your claim holds up. One important note before we begin: this channel is educational only. We are not a government agency. We are not affiliated with or endorsed by Go Business, Enterprise Singapore, IMDA, SkillsFuture, or any government body, and nothing here is official advice. What qualifies differs from scheme to scheme and is updated over time. So treat this as a general guide to get you thinking clearly, and always confirm the exact qualifying cost for your grant on the official source, gobusiness.gov.sg, before you rely on any of it. What a qualifying cost means. So what is a qualifying cost in plain terms? When a grant says it supports a project, it does not hand you money against your total spending. It defines a specific list of cost categories it is willing to help pay for, and only spending that falls inside those categories is eligible for support. Everything else is simply out of scope, and you fund it in full. Think of it as two buckets. The first bucket holds the costs the scheme recognizes as directly tied to the outcome it wants to encourage, and those are your qualifying costs. The second bucket holds everything else, the costs the scheme considers your normal business responsibility, and those never draw down any grant. The reason this matters so much is that owners tend to look at the headline support level, imagine it applied to their whole invoice, and build their budget on that assumption. When the claim is assessed against only the qualifying portion, the actual support can be a good deal smaller. Getting clear on which bucket each cost lands in before you commit is what keeps your expectations and your cash flow honest. What usually qualifies? Let us look at the kinds of costs that commonly do qualify, keeping in mind that every scheme draws its own lines. Across many Singapore grants, the costs most likely to be supported are the ones you pay to an external party to deliver the project. Third-party consultancy and professional services often qualify, where you engage a qualified provider to do work you could not do in-house. Approved software and equipment can qualify, particularly where a scheme supports specific solutions, though the item usually has to be the thing that delivers the improvement rather than general office kit. Training costs can qualify where staff are being upskilled as part of the project. Certification, and in some cases costs tied to intellectual property, such as registering or protecting what you create, can qualify under the schemes built for that purpose. The common thread is that these are costs directly and specifically incurred to achieve the project outcome, paid to a third party, and clearly evidenced. If you can point at a cost and say this exists only because of this project and it was delivered by an approved or external provider, there is a reasonable chance it sits in the qualifying bucket. But reasonable chance is not certainty, which is why the official scheme page always has the final say. What usually does not? Now the other bucket, the costs that typically do not qualify, because knowing these upfront prevents most of the disappointment. In many schemes, your own internal staff salaries do not qualify, even when your people spend real hours on the project, because the grant is not there to pay wages you would be paying anyway. Ongoing operating and recurring costs generally do not qualify either. Things like monthly subscriptions that continue indefinitely, rent, utilities, and general overheads, since these are the normal cost of running a business rather than a one-off project investment. GST is commonly excluded, so you usually work from the amount before tax. And this is the big one. Anything you incurred before your application was approved is very often ineligible, because the support is meant to help you decide to do a project, not to reimburse something you already started. If you sign, pay a deposit, or begin the work early, that cost can fall straight out of the qualifying bucket no matter how relevant it looks. None of these exclusions are meant to trip you up. They simply mark the line between what the scheme sees as project cost and what it sees as your ordinary cost of doing business. Home support ratios apply. Here is where the support ratio comes in and why it is so often misread. A grant will state that it supports up to a certain percentage of cost. The crucial word is that this percentage applies to your qualifying cost, not to your total spend. so the calculation runs in two steps, not one. First, you strip your project down to only the costs that qualify under that scheme. Then you apply the support ratio to that qualifying figure. Imagine you spend the sum on a project, but only part of it falls inside the qualifying categories. The support is a percentage of that smaller part, and the rest of your spending, the non-qualifying portion, you carry entirely on top of your own share of the qualifying part. This is exactly why a project that looked heavily funded on paper can end up mostly self-funded in reality. It is not that the scheme changed the rules on you, it is that the ratio was always meant to sit on top of the qualifying costs alone. Once you internalize that two-step order, strip the qualifying first, then apply the ratio, you will budget for grants far more accurately than most first-time applicants ever do. Documenting your cost. None of this matters if you cannot evidence it. So let us talk about documentation, because a qualifying cost you cannot prove is a cost you may not get. For anything you want counted, you generally need a proper written quotation before you commit, one that names the provider, describes the scope precisely, and states the price. That quote is what the application is built around, and later, once the work is done, you will usually need the matching invoice and proof of payment to make your claim. The golden rule is that your quotation, your approved scope, and your final invoice should line up. If the invoice suddenly includes extra items that were never in the quoted scope, those extras may not qualify, and a mismatch can slow the whole claim down. So keep every document tidy, keep the scope consistent from quote to invoice, and keep the dates clean so you can show the cost was incurred after approval and not before. Treat your paperwork as the backbone of the claim rather than an afterthought, because assessors work from what you can show, not from what you meant. Common mistakes. Let us name the mistakes that shrink people's claims again and again. The first is padding the scope, throwing in loosely related costs and hoping they qualify, which at best gets them stripped out and at worst raises questions about the whole application. The second is mixing personal or unrelated business costs into the project, which never belongs in a grant claim and can damage your credibility. The third, and the most costly, is starting early, signing the contract or paying a deposit before approval, which can turn a perfectly good qualifying cost into an ineligible one on timing alone. A fourth is assuming the support ratio applies to the total bill rather than the qualifying portion, then being caught short when the claim comes back smaller. And the fifth is choosing a solution or vendor that is not eligible for a scheme that requires an approved one, so the cost does not qualify however good the product is. Notice the pattern. Almost none of these are about the merit of your project. They are about understanding the definition of a qualifying cost and respecting it before you spend. Bis tanbiwen to the thinken sa mental fund, falgan the migushan proftenant. Panta si Jeremio de titinons, fernini si pisang. Start on the official channel rather than a forum or an old article, because the qualifying cost categories, the exclusions, and the support ratios all live there and are updated over time. In practice, the Business Grants portal on gobusiness.gov.sg is where many schemes are applied for, and the relevant agency pages, whether that is Enterprise Singapore, IMDA, or another body depending on the grant, set out exactly what each scheme will and will not support. Read the qualifying cost section for your scheme slowly, note what is included, note what is excluded, and note whether the support ratio sits on the whole project or only on certain categories. If a cost is not clearly listed as supported, assume it may not be until the official page tells you otherwise. That habit, confirming each cost against the official source before you commit, is the single most reliable way to avoid a claim that disappoints. Quick recap. Let us pull it together. A qualifying cost is a cost the scheme has specifically agreed to help pay for, and grants co-fund only a percentage of that qualifying portion, never your entire bill. The costs most likely to qualify are third-party services, approved software and equipment, training and certification or intellectual property under the right schemes. The costs that usually do not are internal staff salaries in many schemes, ongoing and recurring operating costs, GST, and anything incurred before approval. Apply the support ratio only after you have stripped your project down to what qualifies. Document everything with matching quotes and invoices, and never start the work early. None of this guarantees you a grant, and because the exact qualifying costs, exclusions, and ratios are set officially and change over time, The live details always come from gobusiness.gov.sg and the relevant agency pages, never from memory. A closing reminder. Remember the spirit of this channel. Our job is to help you read a grant the way an assessor does, so that when you look at a scheme you can see straight away which of your costs will actually draw down support and which you will carry yourself. But the official sources always have the final word. Nothing here is a promise that any particular cost qualifies for your scheme, because the categories genuinely differ by grant and change over time, and we cannot approve, secure, or guarantee any funding for you. When you are ready, map your project costs into qualifying and non-qualifying, get proper quotes before you commit, read the qualifying cost rules for your grant on gobusiness.gov.sg, and apply before you spend. If this made the money side of grants clearer, subscribe for more plain English Singapore grant explainers, and we will keep turning these schemes into plain English, one cost at a time, so you can budget with your eyes open.